Welcome to the Allan Small Financial Show. Thank you for taking the time out of your busy day to spend it with us. Are some of you thinking, is this a good time to perhaps take some profits off the table? Are some of you asking the question, why has the market been so volatile over the past week? We had a great run over the first 7 months of the year. And as we moved into August, we've seen a little bit more volatility than what we've been used to. Well, we're trying to bring you those answers here today. We have a number of topics that we will get into, where we're going to answer some of the questions that I've been receiving over the last few weeks since our last show. Let's put up some of those topics for our show today. We're going to speak about jobs. We just got a jobs number out of the US and Canada. Both numbers were disappointing. Both numbers were below what we were expecting. How did that affect the markets? And what does that say about the economy? We're going to have our usual segment, which is the This Week segment, where I talk about what I believe is important for individual investors to consider over the next 5 to 10 business days. Selling in a heated market, as I said off the top of the show, is it time to take some profits off the table? Are people asking me the question, should we be selling at this point in time? The current rally, how it's the most hated rally that I've seen in quite some time. Coming into this year, many people didn't believe that we were going to see a good market. Many people were preparing for a recession. So this has truly been one of the most disliked rallies that we've seen in many years. Artificial intelligence. Can we still buy into companies that have spoken about artificial intelligence, that provide the chips for artificial intelligence, that use artificial intelligence for things such as search? And lastly, your questions. I want to answer as many questions as I can at the end of the show. And if I don't get to your questions this go around, then hopefully you'll put them in the chat box. I'll receive them and I'll be happy to answer them during the week or perhaps on our next show. So without further ado, let's get on with the show. This past Friday, we received the jobs data out of Canada and the United States. Both were disappointing. Jobs data in the United States, we were expecting just over 200,000 jobs created. We ended up seeing a number of about 187, 188,000 jobs created, below what was expected. Here in Canada, we were expecting about 20,000 jobs created. We actually saw a negative number. We haven't seen a negative number in a few months. Last month, we saw tremendous job growth. This month, negative 6,400 jobs. So that means we saw jobs being lost. What does this mean for the overall economy? What does this mean for central banks? Well, in my opinion, it just shows us once again that the economy is continuing to slow. Perhaps slowing in Canada, maybe even more than it is slowing or quicker than it is slowing in the United States. In the US, 187,000 jobs. That's kind of like what we call a Goldilocks scenario. You know, not too hot, not too cold, kind of just right. We were hoping for a number just below what they were expecting, and we got that number. And the market was really happy when we received that data out of the US. The market actually went higher on the open. In Canada, it's a number I think we were a little disappointed in. Yes, we didn't want to see a blowout number because that would mean that perhaps the central bank, Bank of Canada, may raise rates again to try and tame inflation, but we got a negative number. So now the worries are starting to shift to, are we getting closer to that recession, that mild recession that we all have been fearing since the start of the year? Are we getting closer to that mild recession that has been predicted by analysts, investors, and even the central bank? Bank of Canada has said that there was a 50-50 chance that we could go into some sort of recession. They said this at the start of the year. Our markets have been resilient here. Business has been resilient. The economy has stayed positive. But perhaps this negative number is one of the first signs that we could continue to see a slowdown into the fall and into the winter. So I believe this number is actually a positive for the markets in a what is good news is bad news, what is bad news, which we received is good news sort of way, because a slightly weaker number, especially out of the US, tells the central bank that what they're doing is obviously working. Low oil prices, supply chains now pretty good, a lot better than they were a year ago, and a higher interest rate environment is definitely helping to bring down inflation. We've seen inflation fall in the United States from above 9% all the way down to 3%. In Canada, above 8%, all the way down to under 3% on the headline number, 2.8%. Yes, core inflation is stubbornly high in that 4% range for both countries, but I believe that will continue to fall as well. And when we get the next inflation number out of the US, I'm confident that we could see a number with a 2 in front of it, just like we received here in our country, in Canada. So I believe that a slightly weaker than expected number in the US is a positive for the markets, because I believe the Fed may take a pause in the September meeting and maybe pause until their next meeting later in the fall. And I'm hopeful that we've possibly seen the last interest rate hike in the United States. Here in Canada, I am also hopeful that this rate hike in July will be the last one for this year as well. I don't know how quickly they're going to be cutting rates, but in my opinion, if they remain on hold, at least for the foreseeable future, and they don't speak about raising rates or a rising rate environment any longer, I think this will be a positive for the markets as we move into the fall and into November and December. Historically, we know November, December are good months for the year. So overall, jobs data definitely matters. We know central banks are looking at this jobs data, and it is very important for individual investors to consider or to watch before you make your investment decisions and design that portfolio that will meet your needs over time. We actually have a couple of charts that talk about or show us what's going on with the employment data. Our first chart here is on the Canadian unemployment rate. We'll see it here. We can pull it up. And you can see how the unemployment rate has slightly started to tick up towards the right-hand side of this chart. You can see how much the unemployment rate has come down since 2020. And now in 2023, it's been fairly flat and slightly ticking higher, which is what the Bank of Canada would like to see. In the United States, which is our next chart, a bar chart here, you could see the 187,000 jobs created, which again, on the low end of the scale here, you can see all the many months ahead of it or in front of it that were higher than that. We had some numbers well above 400,000 earlier. And overall, you could see that the pattern is definitely falling. Jobs numbers are definitely falling as we move ahead in time. And again, that's what the Federal Reserve would like to see. It's not what we want to see. Unfortunately, a higher unemployment rate means people are losing jobs, and that's not something we all want. But again, central banks are actually saying that it's okay if the unemployment rate were to rise a little bit, because they believe inflation is the greater of the two evils. So slight uptick in unemployment and a slight downtick in inflation would be just what central banks want to see. Now we come to the part of the show where I discuss what I believe is important for individual investors to consider before you make your investment decisions over the next couple of weeks. As you can see here, we always have 3 topics that I like to highlight. First one being U.S. bonds, U.S. government bonds in particular, and the yields on those bonds. How do they affect the markets? Second, we're going to talk about quarterly earnings. We are in the heart of quarterly earnings. We probably just passed the big weeks for quarterly earnings. We had 2 big ones in particular, Amazon and Apple. We will have a few more this upcoming week. And overall, how are the quarterly earnings? How have they fared so far? And lastly, seasonal factors. What do I mean by seasonal factors? And what are seasonal factors themselves? Here we are in the month of August. Is August normally a good month for the markets? How is September? How is October? What can we expect historically from these months in terms of rates of return? So let's move to the first topic, which is U.S. government bonds. And as I said, U.S. government bonds have played an important part in how the markets move over the past, let's call it week or two. We've seen as the 10-year U.S. government bond rate has gone north of 4%. The market hasn't really liked that too much. And some of the interest rate sensitive parts of the market, like technology, have actually pulled back. We have a chart here on the 10-year Treasury rate, or the 10-year US government bond rate, and you could see it there moving above 4%. For quite some time, the bond was actually well below the 4% rate, and it hasn't been until recently that we started to see an uptick. And when we took this chart, this was sitting around 4.05%, a little different today. But overall, we've seen the bond rates move higher. We've seen the 2-year government bond rate, which we also have a picture of here, a chart of here. And that actually surged above 5% recently. Here it's showing just under 4.8%. But recently that chart would show us that it actually surged above 5%. So a 10-year at 4% and a 2-year at 5%. As bond rates move higher, especially in the US, Canadian bond rates have also started to follow and move higher as well. But the markets don't like that. All of a sudden, you get more of a competition for your investment dollars. It's not such a simple decision. Put money in the market versus buying government bonds. When bonds are paying 5% or over 5% for 2 years, why wouldn't you put money in a bond for 5% for 2 years versus buy a dividend paying stock that might only pay you 4%? And obviously, there are no guarantees that that stock is going to run higher. So government bond rates moving higher has definitely been a negative factor for stocks in general. Obviously, more interest rate sensitive sectors of the market find it more difficult to bring in your money, for your hard-earned money, to invest in them. And so we've seen the tech sector, we've seen real estate trusts and other rate sensitive sectors of the market struggle at these times. So you want to keep an eye on the 10-year government bond rate out of the US, the 2-year bond rate out of the US, and I guess overall what the yields are on government bonds in the US, to know where the market is going and how the stock market's going to behave on any given day. The second topic, as we put up earlier, that I think individual investors need to focus on are quarterly earnings. Quarterly earnings tell us everything. When that CEO comes on and does his media conference call for everybody to learn about how their company is doing, that gives us an insight not only as to how they did this past quarter, the company did this past quarter, but also how that company believes they will do in the following quarter, in the next quarter. And so sometimes that press conference is more important than the earnings release themselves. And I have a chart on a couple of stocks that reported recently, last week. And you'll see here, the first one, I believe, is a chart on Amazon, a stock that I've believed in quite a bit this past, let's say this past 7 months. I've been a big investor in Amazon for, again, my clients that can handle the risk and the volatility that a name like Amazon brings to an investor. But you can see here how well Amazon has done this year. It's had its ups and downs a little bit. Nothing goes in a straight line, but you can clearly see coming into 2023 how well the stock has performed. And when Amazon came out with its earnings, it exploded to the upside the following day, up about 10% at one point, and then ended up about 8% by the end of the day as the market pulled back last Friday. Another name that I like as well that had earnings this past week was Apple. Apple didn't fare as well as Amazon. People were actually disappointed in the numbers that they provided us, but I thought they were strong numbers. I really did. And, Apple is making a lot of money now on its services revenue. So all the services it provides, not just a pure, iPhone seller or seller of iPhones only. It has a lot of services, the iWatch, and many of its products that it offers today are now really starting to factor into their earnings. And so here you could see, I believe this chart was taken at the end of last week, and you could see that stock had a rough day. It was down about, just under 5%. Two other stocks I wanted to highlight coming into this week that had earnings, that have earnings this week that I think are important for us to take a look at one is Disney. And I think Disney is a great company. I think Disney down by about 50% from their previous highs. The stock used to trade somewhere about $180 a share. And you can see here by the chart, it's not doing well at all. So Disney's another name I think we need to focus on as to how they're going to do over the coming days and weeks. Another name also to focus on is UPS. UPS always has a lot of things for us to focus on. Obviously, the more packages UPS is delivering, the better the economy is doing and faring. And I think numbers on UPS is also very important for individual investors to focus on. And they provided earnings this week as well. So overall, these are the companies I've highlighted four of them. I think these companies are very important, and you should focus on them before you make your investment decisions. Look at some of these market leaders like Apple, largest company in the world, roughly a $3 trillion market cap. Amazon, arguably the largest retailer, online retailer. Obviously, Walmart is largest retailer from a bricks and mortar standpoint. And then you look at a name like UPS, the companies that are delivering those packages to all of our businesses and all of our homes. Very important company to see how they're faring. Those quarterly earnings, I think, will help us understand what's going on in the economy and with the stock market and help us make our investment decisions over the next couple of weeks. The third topic I want to focus on that I think individual investors should consider is this idea of seasonal factors. And what is a seasonal factor? Well, seasonal factors to me are times in the year where the market behaves a little bit differently. And everybody's heard I guess everybody's probably heard the saying, sell in May and go away. And that means, the reason for that saying, I should say, is that the period between May and October tends to underperform the period from October to May. So that 6-week period tends to underperform the 6-week period from October to May. And during that period of time, some of the weakest months are the months of August and September. And I believe we have a chart here of the S&P 500, which clearly shows that. And you can see here on the far left, you see the market coming down in the month of August and into September. September actually is the worst month for the markets. And then you could see at around October, maybe mid-October, I always like to say sometime after Thanksgiving, we tend to see a pickup in the markets. Now, is this something that happens every year? Of course not. Is this something that will happen this year? We don't know. But more often than not, this seems to be a seasonal pattern. Now, some people will be watching this show and saying, Allan, does this mean we should be getting out of the market? Should we get out of the market in August to avoid this downturn? Well, in my opinion, I would say no, because that was what happened in 2022. We could also have put up a chart from a previous year where that didn't happen, where the markets actually performed better in the summer and actually down at the end of the year in November and December. So history is always the best indication for what's going to happen in the future, but by no means is it a guarantee. But I think individual investors need to be mindful of this. And if you're in good quality investments, if you bought those investments relatively cheap, if those investments pay you a good dividend, I think there's no reason to sell those investments. Yet, if you have some money on the sidelines, perhaps over the next 4 to 6 weeks, or maybe as we move into middle of September, maybe that would be a fantastic time to add money to a portfolio to perhaps buy some good quality investments that may have pulled back a little bit. Not all investments will pull back. Not all stocks will pull back. Some of them might actually move higher. But overall, this time of year tends to be a bit of a softer period, a weaker time. A lot of individual investors go off to their cottages or their summer places, or they go on vacation in the month of August. We tend to find trading volumes are quite low. So if there is a bit of a negative market or negative news out there, markets may pull back, and they may pull back a little quicker because there's just not a lot of volume out there. On the flip side, if there's some positive news, the market actually could go a lot higher very quickly as well. So you never do know. But overall, I think individual investors should consider seasonal factors before you make your investment decisions over the next 1 to 2 weeks. selling in a heated market. The market has definitely been heated over the past, well, let's call 7-8 months. Well, I would say 7 months. We're in month 8 now, really since the start of the year. Nobody thought the market was going to move higher. Well, it surprised us all and it moved higher. So a lot of questions I've been getting, or at least a lot of investors that I've met, some of my clients, some of my investors, they've said to me, Allan, is it a good time to sell? We've gone up for the first 7 months of the year. Is it a good time to take money off the table? Well, there are a lot of ways to answer that question. And before I answer them, actually, let's pull up a chart of the NASDAQ, I believe, and that'll just show you how strong the NASDAQ, which is the market or the index that has the most technology exposure in it, how it's fared. At one point, the NASDAQ was up almost 35%. It's pulled back a little bit recently, as I said, as interest rates have gone higher. Some of the tech stocks have moved down. And again, that number you see there, down 50 points, was at the end of last week. Overall, I would say that there are many ways to sell into a heated market. My favorite way is to take some profit off the table for those names that have gone up by quite a bit. Names like NVIDIA. I believe we have, I don't know if we have an NVIDIA chart, but NVIDIA has been one of the stocks that has performed, I think, the best. And so if you are a investor who owns NVIDIA, perhaps it's time to trim some of those profits. Take a little bit of profit off the table. Take a little money off the table. If you own other stocks, especially in the NASDAQ, maybe you do take some profits off the table. But I don't want you to take money out of the market to try and time it to put money back in the market. To me, that is a recipe for, at times, disaster. Trying to time markets is something, unfortunately, many people try to do, but very few people get it right. And so if you're going to take some money off the table, you're going to sell some of your heated stocks or some of the stocks that have gone up by quite a bit, have another idea ready to move that money into. It doesn't have to be right away, but you got to do your homework, do your research, find names that haven't moved higher as yet. We've seen a lot of the chip makers move higher, a lot of the tech names move higher, maybe move some money into some banks. We've seen bank stocks move a little bit higher in the US and Canada recently, but I believe they still have a lot of room to run. Maybe you buy some pharmaceuticals. Some pharma names have done well recently. Maybe you buy some retail stocks. Names like Simon Property, for example, which I've talked about on this show before. Name like Simon Property, US REIT has done phenomenally well over the past couple of months and moved significantly higher, but I think still more room to run. So selling into a heated market, I think, can be done, but you don't want to sell to just park your money in cash, to wait for the market to come down to get back in. I think that is not the way you want to do it. I think you want to sell if you have another idea. So you're going to sell some profits on the winners to move into some of the names that have not moved higher as yet. Some of the names that represent good value, as I said earlier in the show, perhaps pay good dividends, buy them on the cheap. And so continue to diversify that portfolio. Diversified portfolio is always the best way to go. You never want to be heavily invested in one sector. You never want to have all your eggs in one basket. You want to spread it around. Continue to buy names in other sectors that, in my opinion, still have room to run and still haven't reached their potential as yet. This current rally has definitely been the most hated rally by savvy investors. And I chuckle when I say that because most investors that I spoke to coming into 2023 thought it was going to be a difficult year again. I don't know why they would have thought that, because as we know from history, very rarely do we have two negative years in a row. The last time we saw back-to-back negative years was not since the 2001-2002 timeframe, actually 2000 to 2002 timeframe in the US. And in Canada, we saw back-to-back negative years at that time as well. Prior to that, you have to go back all the way to 1987. So we've only seen, I guess, in the last, what has it been, 35 years or so, one time where we had back-to-back negative years. And yet coming into this year, many believe that it was going to be a difficult year, that we were going to fall into a recession, whether it be a mild or a deeper recession. Most investors figured that was going to happen. A lot of investors thought coming into this year, the only part of the market that would move higher would be oil. And that was going to be on the back of, obviously, what's going on in Ukraine, the Russia-Ukraine war. People thought that there would be a shortage of oil, natural gas around the world, starting in Europe. That didn't happen. We're seeing natural gas prices the lowest we've seen in many years. We've seen the U.S. pick up the slack for oil, producing over 12 million barrels a day, almost 13 million barrels now. So even though the Russians and the Saudis have cut back on oil production, the U.S. keeps pumping away every day. So a lot of individual investors thought that oil would move higher. And actually, up until recently, oil has been one of the weaker performing sectors in the market. And here we have another chart here. We can pull up the S&P 500 again, I believe. And you could clearly see how well the S&P 500 has done, how much it's caught savvy investors off guard. And it's funny how it works, but the more negativity out there, the more I'm actually bullish. It's that contrarian mentality, that contrarian view of the markets. That's what I want, and I'd like everyone to have. When those are pessimistic, those are fearful, as Warren Buffett says, that's when you need to be greedy. That's when you need to buy. And so this being a rally that most people didn't believe in for quite some time, that people have been fearful of since the beginning of the year. And yet, look, the market has gone up pretty much from the lower left at the beginning of the year to the top right. We've seen a bit of a fall off, I guess, in the last week or so. And as I said in my last segment, we could see maybe a mixed bag over the next month and a half because of seasonal factors, because of low trading volumes, etc. But overall, it's been a very strong year. And what's been leading the S&P 500 has not been oil. It's actually been technology, as I said. And so savvy investors got it wrong. And as these savvy investors now realize they've gotten it wrong and start chasing this market higher, what does that mean? Well, they start putting more and more money in because they want to join the party. They want to get a piece of all this growth. And so that just pushes this market even higher. But I will say, as a contrarian, when we start to see some of these bears, some of these negative investors starting to get in the market and capitulate and give up, that's when, yeah, maybe you want to take some profit off the table. As a contrarian, when people are buying, you want to be perhaps taking some profit. When they're fearful, that's when you want to be buying. So wanted to point out in today's show that all those individuals that you may hear, see on the TV, or read about online, talking about all this doom and gloom at the start of the year, the impending recession, we just have not seen it. And as I said, unfortunately for these investors, it's been the most high-hated rally for them because they haven't taken part in it. Luckily for us, we've been talking about buying into this stock market since the beginning of the year, buying technology for specific sector, in particular technology, and that has fared a lot of us quite well. So going forward, try to, I guess, not really listen to a lot of the noise from some of these savvy investors because unfortunately they've got it wrong until now. Hopefully they'll get it right going forward, but you never know, right? You never know. When the money starts pouring in, maybe that's when we start taking a little profit off the table. Not all of it, but maybe start trimming those profits as part of a risk management strategy. Artificial intelligence, still two words that come up all the time. They come up in conference calls when the CEOs have their conference calls after they report their earnings. They come up when you read about what companies are working on. You know, it's funny when company mentions the word artificial, or the two words, artificial intelligence, or the two letters, AI, companies zooms higher. Everybody is waiting to hear those words, especially in technology land. When a company has incorporated artificial intelligence, or when a company is building the chips that power artificial intelligence, or using it to some degree in their search engine like Google or Microsoft, or in their cloud or software, you name it. When AI is spoken about or has been spoken about, that's usually a positive for many companies. So can you continue to invest in these companies? Well, my answer to this question that I've said many times before is, I don't think you want to invest in companies just because they've mentioned the two words artificial intelligence. I think you want to buy good quality companies because they have good businesses. And if AI is now becoming more and more a part of their business, so be it. That's gravy. That's just the cherry on top, if you will. And we know a lot of companies are saying that they're using artificial intelligence or incorporating all artificial intelligence because these companies are not silly. They know that by saying this, they're going to get a bump up in their share price and that people will look favorably on their stock. And we have an ETF chart here, I believe, that we could show, which clearly shows an ETF. So this would incorporate many different companies that are using artificial intelligence today. And you could see that if you were going to invest not just in one stock or one company's shares that has spoken about artificial intelligence, but the sector in general, look how well you would have done. Look where this ETF, so basically an ETF is a basket of companies, artificial intelligence companies, that if you would have invested in this ETF or this basket back, let's say back in October, November, or even at the start of the year, look how much you would have run up. Unbelievable run that you would have had in artificial intelligence companies. So to me, it's not about just buying the companies that have said that they are using artificial intelligence, or the companies that are providing the chips. And we have another chart. I think we have the NVIDIA chart again. We can pull it up here. So NVIDIA is powering, I would say, 90% of the artificial intelligence today is working with NVIDIA chips. We know that AMD is also starting to get more and more involved in the artificial intelligence. They said most recently on their conference call that they think their business is going to grow by 50% coming up just because of the artificial intelligence, that their artificial intelligence business is going to grow by 50%. So we know that this is an area of the market that has done extremely well. We know that this is an area of the market that probably will do well going forward. But we also know that you just can't chase these companies. You can't chase every company that mentions the two letters AI. You want to own good quality companies that have good businesses. And if they're using artificial intelligence on top of those, or in addition to that business, those are the companies you want to own. And you don't want to chase. You want to own good quality companies, and you want to own them if they pay a dividend. Unfortunately, not many tech companies do pay a dividend. For those that do, like a Broadcom, NVIDIA, unfortunately, doesn't pay much of a dividend. But you can find a few companies that pay maybe 1-2% dividends. Apple pays a 1-2% dividend. But overall, these are the companies that are going to power the growth part of your portfolio. But definitely don't chase. Definitely continue to look at good quality names. And as I said, if they use the two letters AI, that is just gravy. And hopefully that will help power these shares higher. Now's the part of the show that I like most. It's when I get to answer your questions. And, we always get questions during the shows. Hopefully, questions continue throughout the week, throughout the 2 weeks until our next show. Happy to answer them on our next show. Please put them in the chat box. And we'll pick those up. And if I don't answer them on today's show, happy to answer them on the next show or during the week before the 2 weeks show comes. So the first question I want to, get to is here. I got a bunch today, which is great. How do you know what the right time is to sell a stock? So how do they write this here? How do you know when is the right time to sell a stock? We touched on that a little bit when we talked about selling into a heated market. I think you really have to do your homework. Sometimes you want to take all the profits. Perhaps if you think a company has run its course, that maybe it's getting a little bit too expensive, maybe you want to sell the whole name. If a company you think may have room to run higher, perhaps you just trim some of the profits. And how much you take off the table, I think, will depend on how much you have invested in that stock. So it's not an easy answer, always take 10% off the table or 20% off the table. It's going to really depend on how much money you've made, how much your investment is, how much of the portfolio overall that investment makes up. So tough to say. Everyone will have to answer that question on their own or ask their investment advisor. Or if you're not sure, send an email to me. Give me a call. I'd be happy to help you answer that question. But overall, I think, knowing when to sell really involves, bottom line, doing your homework, understanding what the company is doing, understand what the company is saying, how they're performing. And if it's not a stock, maybe it's a mutual fund. Have things change with that mutual fund? Has the mutual fund manager changed? Maybe their mandate has changed. When do you sell a bond? Well, perhaps you sell a bond again. If there's been a nice gain there, maybe you trim some of the bond. Usually with bonds, I don't like to sell them. I usually hold most of my bonds to maturity. Very rarely will I take a profit in a bond. Most of the time, I buy it for the low risk part of a portfolio. Let's do a second question here before we go. Here, a general question. What kind of investment advisor are you? What is your investment style? How do you differ from an investment advisor at the bank? Fair question. What kind of investment advisor am I? Well, again, a lot of ways to answer that question. I think I'm an investment advisor that really tries to help the individual sitting across the table from me. Now, I know you're going to say, well, all the investment advisors should be doing that. But I think we do it at the Allan Small Financial Group. We do it slightly different. We don't have a cookie cutter approach. We don't have any pre-created portfolios that when you come in to see me, I just slot you into by getting you to fill a survey and then saying, oh, you filled out the low risk survey, so you're in low risk and these are the investments you're going to own. What kind of investor I am, or an advisor that I am. I'm an advisor that builds portfolios from scratch to meet the needs of individual investors. What is my style? As I've said on previous shows, I have a GARP approach, which is growth at a reasonable price. I will buy an investment if I think it's trading at a reasonable price. I won't go chasing a stock if it's already moved too much higher. I will be, very measured in what I do. At the same time, just because a stock has moved higher, it doesn't mean that we won't take a look at it. Just because a stock is trading near a 52-week high, that doesn't mean that it's not good value. It could mean it is still very good value. So what I want to do is buy individual investments. I want to buy good quality investments at a reasonable price. So with that, I want to say thank you to everybody who tuned in today. I want to thank you for your questions. And please, if you didn't get a chance to ask me a question today, feel free to send us a question during the week. Send me a question and I believe you can still send it right now in the chat box. I'd be happy to answer those questions during the week or at our next show. And as always, we're going to see you again in 2 weeks' time on August the 23rd. And once again, until then, happy investing.